welcome. This is November 2019 already. This is what I call the green sheet, my sort of monthly market update or the investor letter. If you guys don't know who I am, I run SimplePassiveCashflow Posts found on Google Play, Stitcher, Spotify, iTunes, and also I'm trying to grow the YouTube channel a lot more these days. So if you guys haven't checked out the YouTube channel, check that out. Also, if you guys want to get a free copy of my book, you can text 587-317-6099 and text the word ebook to that. Here's what if you guys aren't in the Facebook group, I would get in the Facebook group. This is a poll I posed probably a couple of weeks ago when I read some news where the US and China were going to kind of start their China trade war talks again. It's actually been kind of quiet on that front for the last month or two. And here are the results, what people said. Most people said that Fed will once again cut rates on October 30th. That was kind of the majority what was said there. And I think they did. I don't know if they cut rates, but I know that they sort of said they gave their prospectus was it was going to start to go down a little bit more in the coming year. Something that's been happening sort of recently was there's kind of a definition here, repurchase agreement or repo. So it's a form of short-term borrowing from dealers in government securities. I had to learn about this. I didn't know much about this, and I don't know if it really matters in the grand scheme of things, but just if you guys are really interested in this type of stuff, in a case of a repo, the dealer sells government securities to investors, usually on an overnight basis, and then buys them back the next day. This happened about a month ago, I'd say. And you guys can kind of read the rest. And I would recommend just Googling this whole repo that happened this last month. But basically what happened, the Federal Reserve provided liquidity through injecting about $200 billion in order to calm them. And we all probably slept through this. I subscribe to Richard Duncan's newsletter, and he's one of these financial gurus that I don't know if it's right all the time, but for the most part, the way he looks at the economy is very interesting, and it gives you pretty good perspective. Here is a graph of the Fed's total assets, and you can see there in 2008 with quantitative easing, that was when the rates artificially got cut back and the sort of the money supply almost doubled, or pretty much doubled over the next decade or so. And probably about 2017, they were going to kind of reverse quantitative easing with quantitative tightening, or QT. But as we now know, as of the summertime, we are going back into another quantitative easing round. Some people call this QE 2.0 or 3.0. I forget which one are even on, but they're going to create more liquidity to put into the markets. The reason why, 2008, the reason why you inject fake money into the system is so that it makes the stock, it kind of props the stock market up. And the reason in 2018, just for a little bit of review for everybody, in 2017-18, they started to stop doing this because they felt like the economy was pretty good in that time, and they felt like, hey, we need some dry powder in case some issues comes up in the future. So that was why they wanted to do quantitative tightening. And I think if there's hard economic times in the future, you want to have the interest rates up higher so that you can cut rates, and because that's a quick way of stimulating the economy. So to me, I don't really know why they're doing this, why they're giving up the dry powder now. You might be able to say that maybe, I don't know, Trump is maybe influencing this, or it's something political. to make the stock market is very influential, and the stock market goes ups and downs, uh, and very correlated to what's happening here. So sort of, when they start to reverse on the quantitative tightening and put more money into the system, it kind of blew the Fed's reputation. And they'll be looking to buy back through Q2 of 2020. And that is sort of pro-economy or pro-stock market. I don't know. Does anybody know when the next election is? I don't really keep up on that stuff, but
A year from now.
A year from now. So Q2 of 2020, or so maybe it has something to do with that. Who knows?
Right.
So those of you who are looking to buy single family homes, etc., you guys, I think a lot of times, a lot of beginners will geek out on this stuff. To me, it really doesn't matter what the interest rates are because it trades in such a narrow band anyway. But here's what's been happening. You can see a sort of a downward trend and then sort of an upward trend this last week or two. But I mean, we're in historical low interest rates at this time. Going into rapid fire, a bunch of news articles that I found with a little bit of commentary on the side. And Amanda, thanks, Amanda. And so November 2020 is when you have to really decide who you would like to be your elected officials. My thought is, like, everything in the government takes a lot longer than what they say. So if they say they're gonna, keep buying back till Q2 of 2020, they're really gonna finally get to the end of Q2 of 2024. Everything just takes longer. So this chart is showing, I got this from Commercial Property Executive, and it's showing net operating income, which is essentially how much profit you're making minus your debt service, versus how much CapEx, capital expenditures, there are. And this is exactly showing what we all think, where older the properties are. See, on the left side, you have properties in the 1960s. They have a percentage of CapEx, and it kind of creeps up to the newer properties. It's sort of directly correlated. And on the right side, you have different NOI to different CapEx ratios there. Of course, as investors, what we care about is the difference between the two. The way I see it, this is why we invest in like B and C class properties. Those are your 1960s to the 1980s properties. The delta between the NOI and the CapEx is so big, whereas your A class properties, the delta is very small, and that delta is your profit. Variables such as age, location, property type influences this a lot. And I always say these are very high level statistics. So vacancy falls, rent rise for manufacturing houses, says multi-housing news. So here is a chart of manufacturing homes or mobile home parks. Those are sort of the average rents across the nation, across different regions, East, Midwest, Southwest. When I think of mobile home parks in California, I think of the $250,000 ones. But most people, that are doing this on a mom and pop scale are buying these properties at $20,000 to $30,000 per unit, and they're renting it out for $300 to $450. And then the little orange dot is the vacancy on each of those regions. Vacancy runs a little bit higher in manufactured housing than apartments. I would say, like a 90% occupied apartment is the equivalent of an 85% mobile home park. So this I took from an article from Yardi, and they had 5 markets with greatest occupancy loss. And right there, you could kind of see, hey, this is clickbait already, right? Like they're gonna create an article like this to scare people. And oh my goodness, is my market in this market? I'm invested in these markets. So Midland, Odessa, Florida, Chattanooga, Scranton. I think that's in Pennsylvania. I'm just guessing because that's where Office Space was, and Youngstown. A couple of those markets I'd never even heard of, and I bet they're very smaller markets, more tertiary markets. I'd rather see this more on a, not sub-market, but like more major market, like Orlando or Kansas City or Birmingham, that type of level. But I call this fake news, or it's not really important because we got one property in Chattanooga that's kicking butt right now. It's Class C, so it totally debunks this whole article right here. Next up from Apartment List, the November 2019 rent report. So this is showing this. There's sort of a seasonality with rents going up in the summertime months, spring and fall, and obviously, you're kind of lucky if you can fill a vacancy in the wintertime from October to February. And that's probably why it is near 0% at that time. And you get it back in the warmer time when people are moving around, changing schools, etc. But this is a pretty interesting chart where you're kind of seeing it in where we are 2018-19 in relation to other years. And obviously it's not like 2014, 15, 16 were amazing years. I wouldn't expect to repeat that again in the near future. But this is just, for newer investors, hey, you got to consider seasonality throughout the year. Right now, I have a rental property that we're going to fix up, and I'm not in any rush to push my contractor or my property manager because I know that it's not very much chance of getting it rented during December, January. So I'm not being a jerk to them, and I'm not, burning up my social capital that I have with them to kind of push them along on the rehabs right now. Bet it's if it's going to be February, March, April, yeah, I'm going to be on them. But this is time where you have to there's a slow season in anybody's workload. Jim's a CPA. He's taking it easy right now.
That's right.
That's life. So region, this I got from ALN. They sort of did a 2019 Q3 review. And I was just going to flash this up on the screen. I record all these presentations and put it up on SimplePassiveCashflow.com/investor letters. If you guys want to go to the YouTube video and read your region, what they said was going to happen, you guys can take a look at it later. I'm really interested in this Georgia, this southern region. And region 5, I think for the most part, every region is sort of just creeping along. I think 2019 is going to end up to be a pretty good year in terms of rent growth. And that's how I measure the pace of the market, rent growth. That's sort of a great indicator of demand. As opposed, I don't really look at the market prices because that's more of a, I guess that's a speculative homeowner buying that stuff. And I guess they do sort of go hand in hand, but there's a lot of spikes in that data, whereas the data with rent growth is a lot more more steady. And nobody cares about California or Hawaii because you shouldn't invest there. Rent. So here's kind of a fun article I found. So the Bellagio Hotel, MGM has entered an agreement to acquire the Bellagio. And I don't know exactly how old the Bellagio is, but it's not the newest thing out there. That's for sure. And it just kind of shows what happens when these assets age and they sort of trade hands. And this is just the evolution or the maturation of an asset. You know, soon it'll become, I think MGM is also buying Circus Circus too. But obviously there's other hotels that are, I would call them akin to a class C or D class casino, and they just bulldoze those after a while. So these things have shelf life. I do know that there's a couple other new hotels coming up on the strip, and you know the Bellagio is turning into more of a B class hotel asset. Oh, kind of talk about this one. Is anybody here investing in Illinois, Chicago? Well, a lot of people used to invest there doing turnkey rentals, and not a very good amount of operators coming from there. But this is the kind of news that also makes things a lot harder. Everybody wants to get the heck out of Illinois, basically. Probably one of the biggest things you want to look for when you're going to invest in is what is the population doing. And here's some stats. You can go on the U.S. Census Bureau and check it for yourself, but Illinois is going down. Granted, a lot of times you have to like check the submarket and the market in general. Oh, hey Reed, you sent this over. Thanks for sending this over again. But like for example, Mississippi, I believe the population is going down, but the southern part of the state, Gulfport, Biloxi, is going up. So in this article, it's talking about the whole state of Illinois, which you have to kind of read between the lines a little bit. But yeah, I wouldn't want to invest in Chicago, also because it is sort of a blue market in terms of landlord-tenant laws, and it's very dependent on Section 8. I just don't know very many operators out there, so I know a lot more people in other cities, states, so I'm a lot more comfortable. But news like this doesn't really make me interested in the area. People say like there's a big thing about people moving out of Illinois and going to Indiana, and that might be a cause for Indiana being on the forefront of everybody selling turnkey rentals to out-of-state investors these days. So this came from a more commercial storefront article. It says retailers are looking to capture the laptops and lattes crowd. I took that picture from a commercial where I don't know if this is for real because we don't have any Chase Bank, US Bank, Capital One in Hawaii, but I guess they're having coffee shops in these banks to trick people to go in and invest their money at 5 times the nation's average, which I guess they're probably giving them like 0.05% interest rate. But anyway, their new retailing trends to kind of coincide with gyms where parking is 45 minutes. And then they also noted the 4 Fs, which is food, fun, fashion, and fitness, are big retail drivers, which will get people out. Not necessarily to the big malls, but the more the shopping centers. Wow, Amanda says here they're getting 2% in the Capital One high interest savings. How much do you have to have in there? Like 20 grand or 50 grand? That's usually how they get you, right? Next article here is the 2019 Metro Level report for small multifamily, this is the report I like to read. The medium and large markets I don't really pay too much attention to because it's mostly class A or bigger markets in California or the East Coast. So they discuss the differences between the caps on tier 1, 2, and 3 markets. So that's exactly what I was kind of talking about. So tier 1 is sort of an industry term where, you know, it might come from like Fannie Mae, Freddie Mac. They rate different markets. Not that they're saying one is better than the other, but you know, which markets are more stable in terms of, like, a Los Angeles will always be a cool place to live, and therefore that's why the cap rates are low. Same thing like Hawaii or New York. So the blue is showing that those type of I call them primary markets. The greens are the tier 2s, or what I would call secondary markets, and then tier 3s are the red there. And you can see that trend over 2017 to 2019. Tier 1 and 3 are sort of going up. The tier 2 or the secondary markets had a bit of retraction. I honestly don't know what that's all about. That might just be because sometimes what they'll do is they'll move like a Dallas from a secondary to a primary, or from a tier 2 to tier 1. They'll just make moves like that, and that'll throw all their data out of whack. So again, take these charts with a grain of salt. Here's another one. Take another grain of salt here. Worst states for taxes from MarketWatch, which I'm not a big fan of them, but people like them because they make pretty pictures and charts and infographics. But they made this chart for most tax-friendly and least tax-friendly states. And I posted this in the Facebook group, and people were like, what the heck? Like, California is not tax-friendly. What they were referring to in this article, which I failed to put in there, was it had something to do with like landlord, or being a landlord, or property. So, you know, like, I think it comes down to like percentages and numbers. For example, property taxes in Texas are pretty high in terms of percentage, but you're still paying a lot less taxes dollar wise than you are in California. So people get confused all the time, and people who don't know how to run the numbers themselves or compare things apples to apples, they kind of get lost in this type of data. And you know, for a newer investor looking, should I invest in Birmingham, Alabama, or Florida, or Kansas City, Missouri, they might look at a article like this and be like, oh, I'm just going to invest in Florida, best taxes. But what I recommend to people is like, hey, use my analyzer. You guys can get that at simplepassivecashflow.com/analyzer, and go through and input all your estimated taxes, your real numbers, and see what the cash flow is at the end of the day. And you might have, you know, different insurance levels might be different in different states or different regions. The more news, they're kind of wrapping up, going into the holiday season here, and I don't know how they come up with these surveys, but this RE Business Online says they are calling a 4% more holiday shoppers this year. And I say, let's see what happens. But it's nice to see that there's some positive outlook out there for the holiday season. So that's pretty much the end of the going through the articles. I'm going to kind of go through a little bit of what I've been working personally. And then if we've got some time, we'll do some networking here at the end. So I always use Tony Robbins' 6 needs as my guide to what I should do every month for personal development. So first is, you know, how did I grow? So I'm trying to put myself into more speaking engagements. So I went to San Francisco, gave a presentation there. I went to Maui at the Anderson Mastermind there. I feel like I've come a long way since my awkward videos 3 years ago that you guys can still find on YouTube. How I'm trying to contribute back. So I kind of said like last time, like I paid 4% in taxes for 2018, and like New York Times is showing you right here, like the rich people really do pay lower taxes. And what I was trying to do is here in Simple Passive Cash Flow is people who are like good at saving money and are hardworking and make a pretty good salary. I think those are the people that should get pulled to financial freedom first. I'm not saying that people who are born with a silver spoon or with a trust fund, or people who can never really hold down a steady job or make any headway in a career don't deserve it. But I feel like the working professional is people who I'd like to help out and have a sort of soft spot now that I've kind of gotten myself out of the rat race to kind of help out. So one way I'm kind of doing this for myself is I'm starting to do the Augusta rule. So it came from the Masters in Augusta, Georgia, the golf tournament, where I guess the rich people who had political power are able to lobby 14 days of they would rent out their home as a short-term rental. And I guess if it's under a certain amount of days, 14 days, you don't need to pay taxes on it, or sort of a safe haven. So how a lot of other sophisticated investors are doing that these days are, like I kind of did it for myself. I went to all the hotels in Hawaii and I built this little spreadsheet, and I figured out what was the average rent for a meeting room. So I were to hold a personal meeting with myself and a few other trusted advisors, friends, family. And I figured out how much it costed. And it costs about $1,000 to do that, to get a conference room, some coffee, some pastries. And I'm going to do 14 of these a year and try and write off $14,000 from my taxes. Of course, I have to show the income. I can't just write a negative loss, but this is one of the strategies I'm going to try and implement this coming year. And if you guys are interested in that too, always looking to give tax legal referrals so you guys can do the same thing. And I think that's frustrating that most tax or legal professionals you talk to, I mean, look, I'm not giving legal advice, nor am I a CPA or lawyer, but that's why they have a job, and that's why they're stuck at that job. And that's why my license plate says FAT F5, because I got nothing better to do than to apply for a license plate like this in Hawaii. This is another Tony Robbins need that they say is, you want significance. So I paid like $35 to get this cool license plate that I drive around. I don't know. I think it's a cheap, fun thing I do. Another need is getting some uncertainty in my life. So I recently came back from a mastermind, and I realized, talking to some other business owners, that I need to staff up. And this is going to put a lot of stress and uncertainty into my life, because obviously, like most people, I can do everything all by myself, and I don't trust anybody because everybody won't do it as good as I do, is what everybody says. But I'm going to commit to bringing on some folks to help me out in different facets. And if you guys are interested, SimplePassiveCashflow.com/join team is the posting there if you're interested. But I think a lot of people, you guys aren't looking for more jobs. I would say if you have impressionable family members, like kids who can edit podcasts or edit video, who are looking for a summer job and are looking for some mentorship too, yeah, maybe kind of connect us and we'll see if we're a good fit. I know another guy who I had on the podcast, Rocky from the Richer Soul podcast. He makes his like nephew do the podcast. He pays him, but he says like subconsciously the kid is picking up what's been said in the podcast. So that's a little bit of a hint that maybe you should you know, maybe if you have a nephew, either he's going to go sleep on your couch and leech your money in the future, or maybe you do something now about it to get him around the right people. So how do I get certainty in my life? Well, we're going to close 5 deals this year. Here they are: El Paso, Gulf Shores, the mobile home parks, the 80 unit in Gulfport, and then we are looking like we're going to close this Huntsville and Irving deal in about a week or so, crossing our fingers. But now it's time for vacation time. And loving connection. I've kind of been busy with these deals, so I told my wife we'd kind of do something for fun for once, instead of, you know, always traveling to do something, to visit investors around the country, or always doing it for work, or visiting some mobile home parks out in Alabama. So I'm gonna go to Japan because I like to eat stuff out there. So that's what I'm gonna do. I always recommend people to, here's what I do every month. I look back at what was my barriers, my resistance that I faced this month. And for me, I wake up to about 40, 50 emails every morning, which sounds like not that much, but you have to realize I unsubscribe for every little stupid email newsletter. Please don't unsubscribe from the Simple Passive Cashflow emails. Let me know if it's too much. We can just put you guys on the deals only list. But I would get really stressed out when I wake up to all these emails, being in Hawaii, being all these hours back. So earlier this week, I committed to every single newsletter that I still want to read. I created a filter and a tag so it gets out of my inbox and goes to the read me later tag. So now I only have about 20 emails and I can get through them in the first 30 minutes. And it's really helped me just remove the extra noise in my life. Everybody likes these ones, like, what is the crap I bought this month? So I broke down and I bought YouTube Premium, which I do suggest. So you pay, I think you pay like $10, $11 a month. It's more expensive if you go through the app. So I would recommend going through the computer, the desktop, to initially buy it. But now you get to skip over all the ads. And for the first day you start to play with this thing, it's like video crack. Like, it just keeps playing and playing and playing. So you got to be careful. You know, you try and save time and not having to watch these ads, but you may watch like 10 times as much videos. But I just watched like the whole Chrono Trigger complete story explained, which is like an hour. I watched it at 1.5 speed, but then I also end up watching these other things that just took my time away. But maybe it wasn't the best purchase in terms of productivity, but you know, you pay. Sometimes it's good to pay, and most people won't pay for this stuff, so I think it's a good deal for premium subscribers. So another book I'm learning about is Gary Vaynerchuk's Crushing It, which is sort of about entrepreneurship. If you guys have read this book, drop me a line. But I'm trying to read a book a month trying to read a book a month via audiobook. I just tell Alexa, like, oh shoot, I said her name. But I'm telling, you know, fill in the blank name to read my book, and then it reads my book the last place I left off. And I put Alexa all over my shower and all that kind of stuff. There's no camera on it, so if you hack into it, you won't see anything. But I just put that thing all over the place now. So kind of wrapping things up, the Passive Investor Accelerator and Mastermind is going to be launching for 2020. There's enough members in it that I'm thinking about breaking it up in 2 groups of more accredited investors and another subgroup with guys trying to pick up their first rental property or turnkey rental. Right now there's about 50 people in this paid mastermind. And that's something I'm working on in the future. Maybe in 2020 is the year I start to do that. I'm still kind of tinkering around in my head how to do this. But you know, if you join now, you'll get access to both groups. And that is 27 weeks of this closed membership site and an e-course, which I'm going to start to launch that soon as its standalone product. And then we do these bi-weekly Zoom calls and these breakout rooms, which you guys have tried out as we started the presentation. But this is kind of the open question and answer segment. Here are some of the articles and podcasts that I released this past month. We had that very emotionally moving podcast about the W-2 lawyer spilling his guts out of what's messed up about being a lawyer. That was podcast 169. We had another live coaching call, which I think a lot of you guys like. We've had a lot of non-accredited guys. I got a more accredited investor coaching calls unreleased, so I'll get to those here soon in the next year probably. Did a presentation on the cap rates, explain. These are all online. Simple Passive Cash, so you just go to the blog section or the all content page. But any questions? If not, we'll go to some more breakout rooms and we'll call it an evening.
Hey, Lane, I have a question.
Yeah, go ahead.
On one of your email updates, I think you had mentioned how you are using bonus depreciation and cost segregations to avoid having to do 1031 exchanges in the future.
Yes. Yeah, I mean, so 2018, I sold off a lot of my turnkey rentals that I bought via 1031 exchange, right? And I knew I was going to get hammered with taxes. And I did, because I had $200,000 of capital gain from selling those 7 properties. But if you recall, when I posted that screenshot of my taxes, a few lines below, I brought over $200,000 of passive losses, which extinguish those gains to 0. So I've been in these deals for quite some time now that I have several $100,000 of passive losses to kind of reach into the bucket to use when I need. And I have this legal notice and disclaimer up right now on the screen, so it's a good timing for that. But I don't know, look, I don't know how it exactly works. That's where I just put my hands in the tax professionals. That's what happens. So the whole idea is, if you go into these deals, you get they're doing cost segregations, you're getting the bonus depreciation, which, by the way, goes away entirely in 2026. You kind of pick up those passive losses and you kind of put it in your back pocket till you need it. Like, it kind of makes sense, Keith? Or?
Yeah, so it sounds like kind of timing the acquisition of new properties to gain more depreciation and balancing that against the timing of selling your properties where you will realize the capital gains.
Right, and the tricky thing is, like, it's not going to be, you're not just going to go into 2 deals at 50 grand a piece or 100 grand and get your passive losses up in 1 year. It's going to take a few deals to get over $100,000 of passive losses at that pace. So, I mean, I don't know if you want to throw out a number of what capital gains you're looking at, but you got to be strategic how you do it, right?
Yeah, that makes sense. Do you know if that can impact the depreciation recapture as well, or is that just capital gains?
So the way I understand it, and I could be wrong, but depreciation recapture is capital gains essentially. It's both gonna whack me. I don't know if they're different.
Okay, makes sense.
Right, like, out of that $200,000 of capital gains line item, I don't know how much of it was appreciation in the properties or recapture from the previous 1031 exchange I did into that. I don't have a clue. At the end of the day, it doesn't really matter because it just got extinguished by the passive losses. I don't know. Jim want to chime in or not, but
Yeah, the depreciation recapture comes into play with your cost basis, right? So once you change your cost basis, right, it actually comes into your capital gains indirectly. So that's what you said.
right. So when you sell the property, you're going to realize that capital gain.
Right. Okay. Makes sense.
Right? I mean, every situation is different. I mean, what are you trying to sell that you're going to get whacked on? What are some of the numbers?
Oh, this is a large commercial property that my family owns. So
Oh,
it's,
you're screwed. Yeah,
Yeah.
I already know how that's going to end.
I don't think I can buy enough new bonus depreciation to offset that. So we're looking at a 1031 definitely. But
Well, you know, you might, I mean, it's a little more fringy, but like you might want to look into or not life settlements, but non-conservation easements or oil and gas investments. You know, that the thing you're talking about is a pretty big whack. You know, I hear guys using land conservation easements. They might put 50 grand in there and get $250,000 of expenses to offset that at a 5-to-1 ratio. What you put in, you get like a 5-to-1. But maybe we'll do a talk about that in the mastermind one of these days. It's probably a little bit over most people's heads. All right, everybody. We'll catch you guys next time. Thanks for joining us. Bye.
Thank you, Lane.
Alexa off.
No, you activated ours.